Ray and Linda Kowalski saved for 30 years. Ray ran a production floor in Columbus, Ohio. Linda managed the front office at a middle school. They maxed out their 401ks. They paid off the house. They delayed Social Security until 66. But they never opened a Roth IRA. And every retirement video they watched said the same thing. Tax-free income means Roth. No Roth, you're going to pay. Ray told Linda they'd probably owe $10,000 or $12,000 a year in federal taxes for the rest of their lives. That's what they paid while they were working. Why would retirement be any different? Here's the thing. Ray was wrong. And if you're watching this right now thinking the same thing, you might be wrong too. 3 out of 4 baby boomers don't own a Roth IRA, and 70% of Americans say they're worried about taxes in retirement. If that sounds like you, stay right here, because by the end of this video, you're going to see how Ray and Linda collected $97,000 in retirement income and paid $715 in federal taxes. Not $7,000, $715. No Roth, no conversions, no special accounts. They used 3 tools that are already sitting inside the tax code, tools that most retirees never learn how to use together. And one of them most people don't even know exists, Congress created in 2025. Quick note before we go any further. I'm not a financial advisor or a government employee. Everything in this video is for educational purposes only. For your specific situation, always check with a qualified professional. Now, let's start with the first tool, and it's one the IRS basically hands you for free the day you turn 65. The $47,500 deduction wall. Most people know about the standard deduction. It's the amount of income the IRS lets you earn before you owe a single dollar in tax. But most people don't know how much it's grown. Back in 2017, a married couple's standard deduction was $12,700. Today, in 2026, that same couple's standard deduction is $32,200. That's more than double in under a decade. But that's just the starting point, because if you're 65 or older, you get more. The IRS gives each spouse an extra $1,650. For a married couple where both spouses are 65 or older, that's an additional $3,300. Now here's where it gets interesting. In 2025, Congress passed what they called the Senior Bonus Deduction. This is brand new, up to $6,000 per person age 65 and older. For a married couple where both spouses qualify, that's $12,000. Let me stack these together for you. Standard deduction, $32,200. Age 65 add-on, $3,300. Senior bonus deduction, $12,000. Total, $47,500. That's $47,500 of income the IRS cannot touch before a single dollar hits the lowest federal tax bracket. In 2017, that same couple had about $20,800 of tax-free space. Today, it's $47,500. That's a 128% increase. Now, I need to mention something important. The senior bonus deduction is temporary. It expires after tax year 2028, unless Congress extends it. And it starts to phase out if your modified adjusted gross income goes above $150,000 for a married couple. But for the majority of retirees, this is available right now. Use it while it's here. So that's tool number 1, the deduction wall. $47,500 of tax-free income space just sitting there, waiting for a retiree who knows how to use it. But the deduction only shelters ordinary income, wages, pensions, IRA withdrawals. What about your investments? That's tool number 2, and this one has the 0% tax rate already built in. The 0% capital gains bracket. In 2026, if you're a married couple filing jointly and your taxable income stays below $98,900, your long-term capital gains are taxed at 0%. Not reduced, not deferred, 0. That's not a deduction, it's not a credit, it's a rate written right into the tax code, and a huge number of retirees qualify for it without even knowing it's there. Here's how it works in plain English. Your standard deduction and those senior add-ons first reduce your ordinary income. Whatever room is left below that $98,900 ceiling can be filled with long-term capital gains, and those gains are taxed at 0. Now, here's where it gets really powerful. There's a strategy called tax gain harvesting. Most people have heard of tax loss harvesting. That's when you sell investments that went down to bank a tax deduction. Tax gain harvesting is the opposite. You sell investments that went up and you pay zero tax on the profit because you're sitting inside that 0% bracket. Then you buy the same shares back right away, the same day. Why would you do that? Because your cost basis resets to the current higher price. The IRS uses that number to calculate your future taxable gain. So you just permanently erased future taxes on that appreciation without changing your portfolio by a single share. And here's a detail that surprises almost everyone. The wash sale rule, that 30-day waiting period you've heard about, only applies to losses. When you sell at a gain, there is no waiting period, no penalty, no problem. Sell Monday, buy Monday. Done. Let me put a number on this. A retiree who harvests $40,000 in gains at 0% every year for 10 years permanently erases $400,000 of future taxable gains. At a 15% long-term capital gains rate, that's $60,000 in lifetime tax savings without a Roth conversion, without changing your investments, without any special accounts. Here's the myth. You need a Roth IRA to get tax-free investment growth. Here's the truth. The 0% capital gains bracket gives you tax-free investment profits right inside your regular brokerage account. No special account required. One warning here. Mutual funds can distribute capital gains to you at year-end even if you never sold a share. That can push you over the threshold. This is one reason passive index funds and ETFs are better for this strategy. They generate far fewer surprise distributions because they do less trading inside the fund. And remember, this is federal only. Your state might still tax the gain. Keep that in mind. So now you've got $47,500 sheltered by deductions. You've got room for tens of thousands more in capital gains at 0%. But there's a third tool, and it's the one that ties the whole thing together. It's about controlling how the IRS sees your Social Security check. Most retirees have no idea they have a dial they can turn. The Social Security blind spot. Here's something most people don't realize. The IRS doesn't just tax your Social Security at whatever your bracket is. It uses a completely separate formula to decide how much of your benefit gets taxed in the first place. That formula is called provisional income. Think of it like a thermostat. The higher your provisional income, the more of your Social Security gets heated up and taxed. Your job is to keep that thermostat as low as possible. Here's the formula. Take your adjusted gross income, but don't include Social Security. Add any tax-exempt interest, then add half of your Social Security benefits. That total is your provisional income. For a married couple filing jointly, there are 3 levels. Below $32,000, 0% of your Social Security is taxable. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, up to 85% is taxable. But here's the key. Even at the highest incomes, the IRS can never tax more than 85% of your Social Security. That means at least 15% of every Social Security dollar you receive is permanently tax-free. No matter how high your income goes, that 15% is yours. So how do you keep that thermostat low? You pull more of your spending from sources that don't count toward that formula. Roth withdrawals don't count toward provisional income at all. Return of cost basis from a brokerage account doesn't count. Only the gain portion does. And here's a bonus most people miss. If you funded a health savings account during your working years, those HSA withdrawals for medical expenses don't count either. They don't show up on your tax return. They don't raise your AGI. They don't touch provisional income. It's invisible money. You can even use HSA funds to pay Medicare premiums. But here's a trap. Municipal bond interest is federally tax-exempt, but it still counts toward provisional income, so muni bonds can quietly make more of your Social Security taxable. That catches a lot of people off guard. And there's one more thing I need you to hear. Those provisional income thresholds, $32,000 and $44,000, were set in 1983 and 1993. They have never been adjusted for inflation, not once in over 40 years. If they had kept pace, they'd be roughly double what they are today.
Every single year, more retirees get pulled into paying tax on their Social Security, not because they're richer, because the thresholds never moved. It's a stealth tax increase hiding in plain sight. Be careful in that middle zone too. One extra dollar of IRA income can make 50 to 85 cents of Social Security newly taxable on top of it. Your real tax rate in that zone can spike to 40% or higher, even though your bracket says 12%. It's called the tax torpedo, and it catches people who don't plan ahead. Before I show you the full case study, I want to hear from you. Drop a comment right now. Did you know the IRS uses a separate formula just to decide how much of your Social Security gets taxed? Yes or no? I read every single comment, and I'll pin the best ones. Now, you know the 3 tools: the deduction wall, the 0% gains bracket, the Social Security thermostat. Each one is powerful on its own, but the real magic happens when you stack all 3 in the same year for the same couple on the same tax return. Let me show you exactly what that looks like with Ray and Linda's real numbers. The $715 tax return, Ray and Linda's full math. Ray and Linda are both 66, married, filing jointly. Here's their income picture for 2026. Social Security, $48,000 combined. That's about $24,000 each, right around the national average for retired workers. Traditional IRA withdrawal, $24,000 from Ray's IRA. This is voluntary. They chose this amount. Long-term capital gains, $25,000. They did some tax gain harvesting from their brokerage account during the year. Total income flowing into the household, $97,000. Now, let's run the math. Step 1. How much Social Security is taxable? Their other income is $49,000. Half their Social Security is $24,000. Provisional income is $73,000. That's above the $44,000 ceiling, so we're in the top tier. Run it through the IRS worksheet, and $30,650 of their Social Security is taxable. That's about 64%, not the maximum 85%. The strategy is already working.
Step 2. Their adjusted gross income. $24,000 IRA plus $25,000 gains plus $30,650 in taxable Social Security. That's $79,650. Step 3. Apply the deductions. Standard deduction, $32,200. Age add-on, $3,300. Senior bonus deduction, $12,000. Total deductions, $47,500. Their income is well below the $150,000 phase-out, so they keep every dollar of the senior bonus. Step 4. Taxable income. $79,650 minus $47,500. That's $32,150. Step 5. Separate the gains. $25,000 of that is long-term capital gains. The ordinary income portion is $7,150. Step 6. Check the 0% bracket. Total taxable income is $32,150. The 0% ceiling is $98,900. They're well below it. All $25,000 in gains are taxed at 0. Step 7. Tax on the ordinary income. $7,150 at the 10% rate. That's $715. $715 on $97,000 of income. That's an effective federal tax rate of 0.7%. Now let's compare that to a working couple. Same household income, $97,000 in W-2 wages, both under 65. Standard deduction, $32,200. Taxable income, $64,800. Federal income tax, about $7,280, plus payroll taxes at 7.65%, that's another $7,421. Total tax bill, about $14,700. Same income, one couple pays $715, the other pays $14,700. That's a $14,000 difference every single year. Ray and Linda keep 99 cents of every dollar. The working couple keeps about 85 cents, and Ray and Linda don't have a single Roth dollar. No conversions, no 5-year rule, no special accounts. Just 3 tools in the tax code used together on purpose.
You don't need a Roth to retire tax-free. You need a plan to use the tax code you already have. The 5 traps that break this strategy and how to dodge them. This strategy is powerful, but it's not bulletproof. There are 5 things that can break it, and I'd be doing you a disservice if I didn't walk you through each one.
Trap number 1. Required minimum distributions. Once you hit age 73, the IRS forces money out of your traditional IRA, whether you need it or not. That forced withdrawal is ordinary income. It raises your AGI. It raises provisional income. It can push you out of the 0% gains bracket and make more of your Social Security taxable. The years between retirement and age 73 are your golden window. That's when you have the most control over your income. Use that window wisely. Trap number 2, IRMA. That stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge. If your income from 2 years ago crosses certain thresholds, your Medicare Part B and Part D premiums go up. For a married couple, the first cliff is $218,000, and it's a cliff, not a slope. $1 over the line, and you pay the full surcharge for the entire year. That can cost a couple about $2,300 a year in extra premiums. Trap number 3. The senior bonus deduction sunset. That $12,000 deduction for a married couple disappears after 2028 unless Congress extends it. When it goes away, your tax-free income space shrinks by $12,000 overnight. Plan for both scenarios. Trap number 4. The tax torpedo. I mentioned this earlier, but it's worth repeating. In the provisional income phase-in zone, $1 extra of ordinary income can make up to 85 cents of Social Security newly taxable. Your real marginal rate can hit 40% even though your tax bracket says 12. Small, careless IRA withdrawals in that zone can trigger outsized tax bills. Trap number 5. State taxes. Everything I showed you today is federal. If you live in a state with income tax, run the numbers for your state too. Some states tax Social Security. Some tax capital gains as ordinary income. Others, like Florida and Texas, have no income tax at all. Your state changes the math.
Here's how to stay ahead of all 5 traps. First, do your tax gain harvesting in the 4th quarter. Wait until your full year income is nearly locked in. That way, you can fill exactly the room left below the 0% ceiling without accidentally spilling into the 15% bracket.